Hey everyone, welcome to this explainer. Today, we're diving into something absolutely fascinating: the hidden psychological shifts that happen as a person scales their wealth from zero all the way to nearly $100 million. Now, we aren't just talking about the dry math of compounding interest here. No, we are looking at the profound and honestly sometimes really uncomfortable changes in human identity that come right along with extreme wealth. We're going to track one hypothetical but entirely data-driven lifetime journey through 5 distinct psychological levels. Let's get into it.
All right, let's start right at the bottom. Picture this. You're 23 years old. You're lying on a secondhand mattress, pulling up your banking app at midnight, and the number staring back at you is exactly $1,247. And just to be crystal clear, that is your entire balance, not your savings. You've got student loans, a credit card bill, and a direct deposit hitting on Friday that, well, let's face it, is already spent.
At this baseline, it's not dramatic or cinematic. It's just a low, constant hum of arithmetic running underneath literally everything you do. Every single grocery run, it's a calculation. You are literally standing in the aisle, putting the good olive oil back and grabbing the generic brand. You're splitting a streaming password with someone you don't even talk to anymore just because canceling it feels like losing ground. You know, money isn't a tool at this stage. It's the air you breathe. You either have enough or you're already suffocating.
Which brings us to level 1, the emotional trap.
So, in this pure survival stage, rule number 1 is incredibly clear. When you have nothing, logic takes a back seat. Your relationship with money is entirely emotional. And here's the kicker: emotional decisions compound in the wrong direction. Any slight setback feels like a total catastrophe. You might get a small raise, feel rich for exactly one afternoon, and then bam, your car immediately needs $900 in new brake pads. You quickly realize that expenses always seem to expand to fill whatever tiny bit of breathing room you create. Your decisions are rooted in fear, in survival. But then, through sheer, brutal discipline, you manage to cross 5 figures in savings for the very first time. You're 26 now, and you take a screenshot of that $10,000 balance. You don't send it to anyone, of course, because no one else would get why it means the absolute world to you. But the psychological weight of that milestone, it feels entirely disproportionate to the actual number. You feel like a totally different category of person.
This represents a massive paradigm shift. You stop hoarding cash just to feel safe, and you actually start investing it to learn how money moves. Money goes from being safety to being information. You finally open a brokerage account. You probably stare at it for 3 weeks before depositing a dime. You put in 1,500 bucks, the market dips the next day, and you almost panic sell. But you don't. That right there is the exact moment you decide whether fear runs your decisions or you do.
Next up, level 2, the competence plateau. Okay, so now you're finally good at surviving, but you weren't really building yet. You're making a decent living, let's say $68,000 a year. You're doing everything right, maxing out the 401k, padding the emergency fund, but then, late one night, you run the math on a spreadsheet. You project out 40 years of disciplined saving on a salary, and something just shifts in your chest. The number at the end is fine, sure, but it is not what you actually want. And that leads to our second rule. A salary is a ceiling dressed up as a floor. Relying on it will never give you true leverage.
As your net worth climbs along this journey, notice how the milestones actually start to compress. By age 32, you hit a net worth of $150K. Why? Because you started a side project. You stopped measuring your output in mere hours worked, and you started valuing time and compounding. You start buying and building actual assets, things that earn for you while you're fast asleep.
But to hit that kind of acceleration, you have to go through a pretty painful social shift. You have to pivot from spending money just to maintain relationships to protecting your capital to build options for yourself. You start saying no to group holidays where you know you'd be subsidizing everyone else. You say no to those pricey destination weddings you can't logically afford. And yeah, you feel the social friction. Some friends get envious or dismissive, but you stay quiet and you say no anyway.
All right, level 3, assets, buying assets.
Here, the whole game changes from saving to strategic leverage. Rule 3, below $500,000, you're still buying assets. Above it, your assets actually start buying each other. Your money develops a personality, right? It has preferences on where it wants to go. You might take a big hit. Say, an investment loses $9,400 in a day, but you don't panic, you don't pull back, because you finally get that this is just the cost of being in the game. People at the bottom tend to think the top is all about avoiding risk. It's not. It's about choosing which risks are actually worth sitting with.
Then, suddenly, you're 36 years old. It's just a random Tuesday. There's absolutely nothing ceremonial about it, but
You refresh your brokerage account and boom, you officially crossed the $1 million mark, hitting 1.4 million. You just sit with it for a minute. You probably expected this huge parade of emotions, but instead, it's just a quiet sense of satisfaction.
But honestly, that satisfaction is short-lived, because the cold, hard math hits you almost immediately. $1 million, right? At a safe, standard 4% annual withdrawal rate, that yields just $40,000 a year. That is a glaring realization. $1 million isn't freedom. It's just a starting point.
So you have to admit to yourself that happiness was never really the point of the grind. The milestone was never the destination. It was simply the proof of concept that your financial machine actually works. You stop going to those noisy, crowded networking happy hours. You realize the real conversations, they're happening in much smaller rooms with fewer people and absolutely no name badges.
Moving on to level 4, the game of positioning.
At this level, money completely stops being a source of anxiety and transforms into a pure resource. You aren't just rich anymore, you are wealthy. And the fourth rule perfectly captures this. Wealth is not what you accumulate, it's what you no longer have to do. The definition of wealth here is literal time. You can take a 3-week trip and deliberately not check your email for 5 days straight. That kind of uninterrupted time is the ultimate luxury, something people at the lower levels simply cannot buy.
The shift we're seeing here is profound. You are no longer working for capital. You are positioning it. You stop trying to win every single hand at the table. Instead, it's like a giant puzzle. You enter one deal that might return huge multiples and another that might return absolutely nothing, fully understanding that the trade is how one investment simply de-risks the other. You're playing for longevity now. The goal is to stay in the game longer than anyone else.
And as you cross into 8 figures, we hit Rule 5. At $10 million, your reputation itself becomes a financial instrument. It earns returns. You get invited to the table by private equity firms or major family offices, and it's not a courtesy invite. It's because your pattern recognition is genuinely useful. But listen, there is a heavy cost here. You might hold equity in a company that lays off 140 people. You know the CFO personally, but you don't pick up the phone. Your position increases in value. You don't feel good about it, but you don't really feel bad for long either. You just feel this quiet, expanding distance between your decisions and their human consequences.
Which brings us to the summit, level 5, altitude and distance.
This is a space characterized by extreme leverage, but also a profound, really quiet isolation. Rule 6, above $50 million, money stops measuring your worth, it starts measuring your reach. At this altitude, your context becomes completely untranslatable to old friends. You aren't a different person, but your reality absolutely is. You don't lobby politicians, you quietly advise on policy. You stop thinking in financial quarters and start thinking in massive demographic and infrastructure cycles. You're positioning your capital way out ahead of them like a seasoned sailor reading the weather 3 days in advance.
By the time you're 61, your net worth hits $94 million. And get this, that exact figure is known to maybe 3 people on Earth. You hold compressed power. You can literally walk into a board meeting with 5 people who hold enough capital to reshape a mid-sized economy, speak for exactly 4 minutes, ask 2 highly targeted questions, and watch the entire room recalibrate around you. And then you leave before lunch is even served.
It's an absolutely incredible ascent. But think about this. Somewhere in the city right now, a 24-year-old is standing in a grocery store line. They're checking a $1,247 bank balance. They're putting the good coffee back on the shelf, doing the mental math, thinking that this whole journey is just a story about money. Thinking that if they just make a little more of it, something internal will magically resolve itself. They don't know what it will truly cost. Not in dollars, but in distance. The financial machine is entirely impartial, right? It will patiently compound the money of whoever shows up consistently without flinching. But the real question you need to take away from this explainer as you look at this incredible journey from 0 to 100 million is this. Are you actually ready for who you will have to become to reach the end?